We sold out.
None of VPN Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPN Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPN Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPN Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Thanks for coming this morning. This is kind of another impromptu meeting. We're going to get a better schedule running as we go, but we appreciate it. As usual, if any time the audio freezes or you stop seeing movement on your screen, maybe it's frozen, you can hit refresh. Also, if you're having stuttering issues, depending on your bandwidth, you might want to try to bring in you can pull back the line just like you do on a video, and it will buffer it a little more, and you'll have a better experience there. Anyway, we wanted to do a meeting this morning with all the cell signals that came in. talk about the market again, talk about some of the things that BPM's doing here. I have the headsets on this morning because we're going to bring Mitch in and we're going to go through a pretty good detail of the database and what's a number of issues that are going on with the database as well. And we'll start off as we usually do, talking about some of the market events. Just a quick review at what we saw last week with the sharp drop. We did see some major numbers taken out on the charts. We've rebounded back to them this morning. The volatility levels continue to be about 22 points per day, and we're right at that. We're exceeding it at this time. So we're pretty much staying within the volatility ranges. And as usual in the markets, and especially over the last maybe 3 weeks, we get the stampede in or stampede out. So let's go and take a look at the markets here real quick. And just let me bring up, we're going to bring up TradeStation. I'm going to try to go through some of the shorter term aspects of what's going on in this in the patterns that are happening right now. And this is just back to the 1 minute futures chart. So we're seeing the activity. We're seeing some pullback off of the highs right now. We're starting to fade just a little bit back to 1830. What I'm going to do here is we're going to go to a couple different graphs I want to look at real quick, and just so we can get some idea here on what's actually happening. This is the weekly S&P that we're looking at. This is typically what you see on the S&P. On this chart I'm utilizing TradeStation. This is model 1.2 that I have on here. Not necessarily the thing that I need to probably reference better is making sure that I have the optimized model for this particular symbol. Right now this is just a static. This particular system does not do the optimization, and I'll always have the best model up like it does in BPM. So there's a little bit different of a difference here. I just have 1.2 on here. There's a couple things that here, the very bottom orange that you see there is the VIX index, and so that's the volatility index, and then the middle indicator that you see is PPM2, which is tied to the 21 period moving average. There's a couple of things that I want to talk about here, and what we saw last week was the drop below some key levels. The 1834 number I talked about on Friday's broadcast was pretty important level. That was last month's low. We did penetrate through that. We traded down as low as I think 1814 or right at 1815, and those numbers are pretty much the extreme of the support levels. And what we continue to see throughout the pattern, and probably going back for the last 3 months, when I talk about some of these extreme numbers, the market seems to go to the extreme every time. It never seems to go close to it. It goes even beyond it or to it, and it happens very quickly. Sometimes I'll be looking at a three-day or 5-day pattern. It should reach, and it's there in 3 hours instead of 3 days. And those are the type of things that continue to happen with these volatility levels that we're seeing. So the volatility that we're seeing right now, so you can see we had a high of 33.61, a low of 18.18. So not quite the 30-point rally, but if you go from or the 23-point average range, but we are getting a pretty decent range here. We did trade up. One of the numbers, S3 is 1836.40, so we came pretty close to that. That's the support. I'm sorry, R3. That's the resistance at 1836.70. We did get up to that level. And it's basically a lot of times, for any of you that have done any type of technical analysis, a lot of times you get a breakdown point like the 1834 number, 1837. These are numbers that we were watching when we were above that level going down. Markets will rebound back to there, and then typically we'll start to retrace a bit. We're off a little bit here at 1830. We're not much. We're really hovering around the highs of the day, and most likely it'll probably stabilize at these levels, but we'll watch as the day unfolds. Looking at the really short-term chart, right, or not real short, but going to a daily graph here, you'll see this pattern a little bit better. In fact, let me just grab and blow up this last section so we can just look at what's happened in the last several days. So you can see we had 3 days down, we had one and a partial day up, and then we got the reversal down that we had last Thursday, and then Friday followed through, and now we're trading. Let's see, are we trading here? Yeah, we're trading an inside session of Friday session right now. So we haven't taken out the low and we haven't taken out the high, and that's a typical pattern that will unfold at this level. Depending on how we close today, just looking at this pattern here, there's a good possibility that the market could continue on. I mentioned in the commentary last night, there's a number that we can get up to around the 1848, 1848.80 level. It probably isn't going to get much above that, but this is the type of volatility that we see in these actions. And the pattern that's unfolding, like I said, is a pretty negative pattern. We look at a short-term pattern, we could see if we can stabilize today, we get another 1 to 2 days up. The key level is going to be this chart right here. That is, this is all the way up at 1872.53. So just 2 days ago we were at 1872. We traded to 1814. Now we're getting a little rebound rally that probably doesn't have a lot of substance in it. And we can see that down here below, once again, as I mentioned, this is the VIX. Now, I fixed one of the things that I had an issue with the other day. Is the whiteboard is now working, so I can point some things out here that I was talking about. This pattern, this channel here that I've just drawn on, this is pretty much what the market's going to stay within this channel. We'll probably get a little stair step up, and whether we get a stair step down, it's really determining at what level, how high does this retracement rally go. As I mentioned, we broke down on a monthly graph. We also broke down on a weekly graph, which I'll bring up here in just a second. Let's go ahead. Let's go back to the weekly real quick. Now, one of the things that, and we're working on a couple things. We'll make some announcements. We had some folks asking about the potential for having getting access to this logic that runs in TradeStation. So you'd have to have TradeStation, and then you'd have to get access to our code. I originally built the models that were in VPM back in 1992 into this platform, and I was the solution provider for many years for TradeStation. We haven't offered it to TradeStation Group since I think 97 or so was the last time that we had any activity with TradeStation from that standpoint. Don't plan on putting this out there. A lot of retail environment there, so there's no plan at the moment. But we're working on some elements that we could possibly offer it out to you folks. So a couple things here on the weekly chart, and I'm going to blow this up as well so we can get, let me redo that. I don't like what I did there. Let's grab this section here so you can see there's some pretty serious movement here, and I'll get the whiteboard out again just so we can I can point out exactly some of these points where I'm looking at here. So this is last week's bar here, and a big time reversal down. These levels right over here, I'm drawing a line under. Those are those key levels that I was talking about, the 1834 levels. This is the cash chart we're looking at now. And you can see that there's a couple key points to look at. The next key point is going to be this big spike low, which is way down at 1737. And I've been talking about for a while, I'm just going to draw a line that's approximate here, is the 1795 level is the key level. A break below that level would actually put us into a longer term neutral to down situation. What we are in now is really a neutral pattern. We've actually signaled an intermediate high at this point, and we're actually signaling that the market is going to go into a sideways mode. What we don't now know is if there's going to be any kind of follow through on the downside as far as as the market trend starting to go to a larger point. When we go in and looking at the analysis of the database from VPM, we'll discuss a little bit more of that. So the other thing we can look at here, I'm going to go back and zoom out again. We can take a look at, I'm going to look at some of the futures markets, and you can see right now this chart here has some cycles on it, but we're looking at the futures markets now. We're not looking at the cash anymore. But the futures markets just recently had a cycle come in here, and there's not a lot of distribution happening. You can see these lines down below, which is a volume rate of change. So looking at how the volume is actually going from a rate of change standpoint, and typically around bottoms or tops we'll start to get some spikes in activity in the volume. And it's interesting because my view on volume is quite a bit different than a lot of folks. I don't view when there's a lot of volume means more is going to happen. It's typically when you get huge volume is when climactic situations happen. Otherwise, you get this big stampede, and that is everything that is going to happen as far as the market goes. It's a climactic high or top, and oftentimes if you do get a big spike in volume, it's within a day, or if it's a big weekly spike, it's within a week or two of a major top. But these cycles are coming in. The interesting thing is here, I know you can't see, it's hard to read these numbers in this little box I brought up right now, but you can, the objectives right now, these dots way above here, let me just bring up the whiteboard so I can point this out. These are where the VPM is doing its price projection technology, and the three arrows I just put up, these are the places where it's projecting it to go to. So in this case on the futures, there's a bit of a discount right now. Futures are about a $7 discount to cash. So 1833 to 1839 is the projections for the futures to go to, and if you added 7 to that, you'd end up at that 1848, 46, 44 level on the cash market. So the futures are projecting this. Typically, it looks like this cycle down below has been a low, and the market's starting to firm just a little bit from the standpoint of the futures are actually starting to look like they're consolidating here at this level, so they found some support. So let's go ahead and take off the arrows, and this is, and what I would show you is that was the really short-term 5-minute cycles that are running. Now what we can look at, this is an hourly cycle, and this tends to happen during different cycles here. And what happens is, bring it. So you can see these are ribbons, exponential moving average ribbons, and they have some interesting characteristics. I'm going to draw a couple arrows on the left-hand side of the chart. You'll see where the short-term averages cross through. When you start to get to a trending mode, there's just a kind of a crossover. Markets tend to trade in or above these ribbons. Now we're above this. We're starting to get some cross through right here with this action. This is an hourly short-term chart. I can change this to a daily real quick, and you can see the different ranges. So it's likely to probably come up toward this top range and then start to flatten out again and maybe head back lower. So it's going to be interesting to watch how these things happen. We're not seeing any big spikes. So when there's tops here, you'll see these spikes. I'm just going to draw a bunch of arrows here. These peak values that we're getting right here, those tend to occur when the market's making major turns. The cycle that comes, you can see it's pretty even, that we get both the volume spikes, and then we get, this is a swing index. This is actually embedded in VPM, it's looking for some major turning points in the marketplace. It helps to identify these things. So this swing index, this was an index that I developed back in back in 1988, I think it was, when I developed the swing index. And this has just given me a feel for extreme points where the market's likely to make a high probability turn in the markets. We really got a spike here to the upside today. This doesn't appear to be one of those turning points I'm talking about. So this rally that we're seeing right now just is going to stay in the channel until it starts to break down. So go ahead and clean this out real quick. So we saw a flat. We're above the ribbons. Now we're rallying up, and we'll probably see some retracement even back into the ribbons, ultimately challenging the lows that we made on Friday. We're a long ways from calling a bottom in this market. I think just because of the pure magnitude and some of the momentum that happened, we're just not going to see that happen from there. So see if there's one more thing I want to show you here. Sorry to bounce around a little bit. On a short-term basis, this is what I was talking about a few minutes ago when we're looking at the 5-minute graph. This is now the 1 minute back to the futures. See, the futures are running up. The numbers on the far left-hand side are actually the bid and ask, and you can see the prices changing and the size of the bid and ask changing. And we're about 2 handles off the highs right now. And so they're trying to challenge this thing. It probably won't make it on this run. We'll probably retrace back, but it's certainly starting to show some stabilization. And what I've seen on days like we've seen and rebound days like this, especially on an inside trading day, we get up toward, if we go over the 1836.70 level, then we're just going to continue for another day or two and head toward the 43 to 48 numbers that I talked about. It would continue on. So the next couple hours are going to be pretty key. And just a minute here, I'm going to bring Mitch in with me and be able to go through some of the things that we want to talk to you about on VPM and just get to that level. I'm going to Mitch, why don't you go ahead and come into the session now?
All right. Thanks, Bob. One of the things, for those of you that are logged into VPM right now, you may have noticed this morning that we just put out a new set of these investment exposure charts. So for better part of the year, we've been producing these charts and putting them on the dashboard. And what a lot of advisors have asked for is, what is the VPM database doing? For some time within the 2.0 system, we've provided the ability for you to be able to take a look at the universe and see how heavily invested are we database versus something like the S&P 500, which you'll see when you log into the 2.0 dashboard. What we've done though is we've dug into our database, tried to make it even more transparent within the last year or so that you can get some real information out of what type of shifts are we seeing within the market. So what you see pulled up in front of you, we have it broken down first on the stock side. So we're starting with the sector exposure up here at the top. And then if you select a particular sector, we can then drill down to the groups underneath that. So if you haven't already seen this chart, or if this is new to you, just to get you acquainted with it, when you look at the chart, you'll notice that there's this light green shaded area, which represents all the stocks in our database in that particular group or investment category that's currently long. The green area, as you'll see right here, signifies the change this week on any new buys. So these are new positions that are getting taken on. The red signifies any new sells that have taken place this week for this particular group or sector. So this gives you a quick view as to what type of shifts are we seeing this week when it comes to particular sectors or groups. Now, if you're looking at it right now, you'll notice, at least on the sector exposure, that most of the pullback has been pretty even across the stock side of things. If you highlight over each of these bars, you can see that it was about a 3 to 5% shift in the percent long. So net, when you take a look at it, counting for any new buys, it was a pretty mild change when it comes to the individual stock side of things. And this is why we highly recommend that advisors have these stock positions, because you're going to get a true picture on what is taking place on stock portfolios, as opposed to looking at the entire composites of the VPM universe or the S&P 500. It's very important where you could find the stocks that are still performing when the market begins to flatten off or begins to pull back. And this is just the very beginning of some of those tools that we're going to be putting out there to help find the gems out there in the midst of a market that could be flat or begin to turn bearish at this time. If you scroll down further down the page, you'll see the mutual fund side of things. So for those of you that are using mutual funds or ETFs within your practice, this is very helpful to see what type of investment groups or investment categories are still currently invested. One of the things that we noticed last year when we were looking at this breakdown, that a lot of the mutual fund fund positions, we were completely out of the fund space. And so if you were looking for, let's say, a taxable bond fund, if you pulled up this chart, you would have found out at that time that we were completely out of just about everything in that space. You see that since then we've shifted where we're fairly heavily invested on the both the muni bond side as well as the taxable bond side. So it's a great way of seeing that shift within the database as to where we're out of a large portion of bonds like we were last year to now being shifted back fairly aggressively invested on the bond side. One of the things I just want to draw your attention to for this week, scrolling all the way down to the bottom of this page, on the U.S. equity fund side, you'll see that this is really where most of the activity was this last week. You can see that we had very, very little activity on the buy side. In fact, on the optimized trade systems, we didn't have any new buys across these mutual funds. All the activity that we saw last week going into today's open was selling on the mutual fund side of things. If you highlight over this, you can see that it was like 24% in the large growth area. The mid-cap side on the mutual fund had the largest pullback, where you see we sold out at 38%. So across the board, I mean, you could pretty much draw a line right here and see that we've now back down to about 30 to 40% invested on the traditional U.S. equity funds. So those advisors that are using a large portion of their portfolios with these domestic assets, these large blend and growth and value positions, you'll see that we're still back in that investment exposure down to that 30 to 40% range. One of the other things that we've also incorporated with this latest chart that we just rolled out today, when you click on one of these bars, you'll notice that list beneath it reduces down. So you can see the particular mutual funds that we're tracking to monitor this particular segment. So I would encourage you to take a look at that, explore this space, let us know what feedback you have on this. We're going to continue developing this, trying to provide advisors with the best tools possible to be able to show what is actually taking place within our database and what they could do within their portfolios, and see if their portfolios line up with what we're seeing universally across the database within our system.
Hey, Mitch, I had a couple of things I wanted to say here. When you're seeing all this activity in VPM, for instance, there were, I believe there were there was 5,119 sells between 1,232. The total orders that came in were 5,802, which included the buys. But when we netted down to just the optimized, which should be what's mostly in your portfolios, there were about 20, I think it was 2,470 and change. And that, so even though there were 5,000 orders, it looks like this huge run. When you go down to the optimized side, the effects, like we said, were a lot of these funds that were being affected were the mid-cap area. And you think about what's been going on in the marketplace, you've seen small cap and mid caps be able to carry things through. So what we've done then is when you look at just from a technical aspect of what VPM's doing, I think it's important to understand that the fact that VPM's selling out of these positions doesn't mean that they're going to decline. It's not a sell signal, like sell short. It's an exit due to a change in the trend probability. So a lot of these funds that we're selling, we've been in for a while. And and there's some that might have maybe been shorter duration depending on the style box that's getting hit. But for the most part, what we're seeing here is, I'm just going to go live so we can talk directly here. What we're seeing here is really just an overall downsizing of risk. So when VPM's selling and eliminating positions, so you look at your cash levels change. So what's really happening here? We're changing the risk profile of your strategy. And a lot of times folks will take too much to heart, like there's some kind of traumatic event happening. That's not what's going on here. What's happening is it's just changing a risk profile. And if you look at what VPM does, we're trying to generate a risk adjusted return over time. We're not trying to beat any indexes. We're trying to flatten out the risk. So when we get a place where we see some selling, we're within 5% of a historical high, we start to see some things move out. I think maybe I can bring up a couple things. I mentioned the death pattern again, and the death pattern is one where the market makes a new highs, but the database is not confirming that. And in fact, the database that when it made the last new high, as far as percent, was way back last year, and I believe it was February or March, maybe it was May. I don't have it right in front of me right now as I'm talking to you, but the bottom line is that's where the peak number of stocks were owned, and since then there's been a lot of incremental changes in the actual risk. So and when you come to an individual stock, it's much different than if you're indexing. So in the case of like ETFDI, I believe we sold the SPY and the mid cap. SPY would have been maybe a small loss from where we came in, and the MDY was a gain. But what happened to the global equity strategies if we've lowered the relative risk? We still own risk, but we've lowered the relative risk in the pattern. And I think that's where a lot of folks that are looking and using this strategy are too tied to the individual trades and what's going on. It's really about changing investment exposure. And theoretically, what we are owning right now, the things that we continue to hold on to are ones that still have relative trending capabilities, or we would have sold those out. And that's what VPM is, a trend following system. So you want to be able to understand what it's doing from there. So the fact that we had 2400 net sales doesn't mean there's some panic and the end of the world's coming. As I mentioned in my technical section, what we're doing is being able to, look at overall what's happening with the chart. So I said there's an intermediate top, there's a short-term top is in place. So all we're going to do is go into a wide trading band. So right now we've established the 1815 as a low, and we've had a high of 1896, and it's probably, if you narrowed it down from here, because we've expanded the range below last month, now we're probably 1815, like I said, 1848, and the market's going to consolidate there. But what's going to happen to these funds and individual stocks? They're going to waffle around within a range themselves, but the probabilities of them making new highs is just not there right now. So the general attitude that I built into the software and how I've run money for many, many years is, if it's not showing trending capabilities, I would rather be out of it totally than own something that could bring in additional risk. So if the trends are not there, I'd rather be in cash than have exposure. It's not an allocation strategy. It's really about exposure and understanding exposure. And so as you look at, there's a couple things that we'll be bringing out to you. And just to mention right now, is we do plan on doing a lot of detailed training that's going to come up. Next week looks like the most likely time where we're going to start doing these sessions. We're going to go through all aspects of utilizing VPM and understanding some of these things. So this is going to be ongoing. Whether there's 100 people or 10 people or whoever, doesn't matter. We're recording these sessions. They're going on our YouTube channel, and ultimately some of these things will probably be cropped out and put right into our VPM Partners website, just under the training. We plan on doing a lot of this stuff, and right now most of this morning we wanted to talk more about what's going on with the database and those type of things, so to make sure that you have good context. Absolutely love days where we have lots of sells and the market's up. You couldn't ask for a better situation, because what's happening here is they're giving you the best price to sell into. You never want to sell into weakness. You want to sell into strength, and that's what they're giving us. So all the mutual fund sales today, the market stays stable, are going to go off at a pretty good rate, better than they would have Thursday or Friday, or probably about the same as they would have, even though the market dipped down lower than that. So if you look at the closing values, but depending on the style box, depending on how the managers have themselves positioned, that is, what's going to happen there. So let's go to a couple other things here. Let's go back to the other chart here, and a couple things that I wanted to talk about, and I'm going to go into VPM 2.0 here. I don't know how many of you folks are fans of Windows 8. I hate it, but you get all kinds of floaters, and this is a touch screen, so it seems all good, but it's really not. So in VPM 2.0, I want to bring up this chart here that is the percent bullish chart, and I want to draw a couple things. I want to talk about this death pattern for a couple minutes, and just start to bring in exactly what I've been talking about on this stuff, so it makes some sense. And as usual, if you have, we're still trying to get a good methodology. If you have any questions, let us know, and we'll try to answer them if we have time here in the live session. So looking at the percent bullish, this is the pattern I was talking about. Now I can give you exactly the numbers that are key. So this point I just drew an arrow to. In fact, I'm going to change my color on the arrow here. I go back to a red. So this arrow here that I just put on, that's where the peak happened. That was way back in May of last year, and I think that's that's the point where I'm talking about. If you look here, this is the trend in each one of these highs. So market makes a new high here. There's a fewer number of stocks that are making a high there. So I take a few of these arrows off, and then as you can see, each time we made a new high, here, we'll just draw a line up here, fewer and fewer stocks are participating. And the last time that we got into this mode, way over here back in 2009 and 10, this took about the better part of a year to unfold, and it's the same situation here. Ultimately what happened is you got this big decline in prices, and all of you will know that is exactly what needs to be done from looking at the database. Sorry, I had a little glitch here in the technology. It wasn't working. The bottom line is these tops are doing exactly what they've done before. We're working on getting some longer term data. This same thing happened in 06 and 07, by the way. The actual peak in the number of trades owned by VPM was in about in May of 08, and the situation that unfolded there, obviously we know what happened. I can't show you on the screen visibly, but it was the same thing that happened. This was the 2011, where you see the database drops to about 10% long, and then it's a question whether we're going to get a big fall off here or not. But here's what's happening. Just going back to the database and what's going on with, and the reason why I follow this percent bullish is what happens is there's a key number, 42%. Typically, when the market goes under 42%, it enters a more sustainable type downtrend. And we're not there yet. We're at 47. We went very quickly from the 60 percentile range down to 47. And that's typically what will happen within VPM is you're going to see these big tranches of orders. So things are going to happen in segments. So market breaks down, BPM is going to respond to those changes as they happen. So what we're seeing here is the same thing, same pattern. In the last couple meetings, I've talked about moving average patterns, all these different patterns that happen. Spending 25, almost 27 years as a quant and looking at these numbers, and specifically I have an edge on folks because I don't read outside research, I don't listen to anyone, I stay within my world, and it's things that I built over years and a lot of confidence in them to be able to understand what's going on with these markets. So it doesn't mean that when these death patterns happen, they roll over right away. It takes about a year, and we're into the year pattern now, about May to May, and these are typically where these things start to happen. If you recall on some of the other, on the annual outlook, talking about Q2 having a top. Well, we're starting to form that. I tried to start to bring some of this stuff out in commentary, is that we're starting to form those tops. We're starting to see the elements continue to flow that tells us that these things are happening. So when you're doing analysis at this level on the marketplace, you're constantly looking for the cues, and you look for the big cues. So this declining percentage bullishness while the market goes higher is one of them for me. Looking at the type of stocks, that's why we went through some of the breakdown. We're continuing to be able to get a lot of transparency, and the rotation that happens internally in a database is really important to understand. As Mitch pointed out, it's interesting, if you recall in the referring to the outlook that we did again, is the expectation was the first 2 quarters we'd have declining interest rates, and there's been some shifts that have happened since I wrote that, and the shift that has happened has been more of a we have a different Federal Reserve. The messages coming out of the Fed right now are very unclear, uncertain. They're dovish to say the least. But does that really mean that they're dovish for stocks anymore, and that maybe the bonds are getting more of the juice or the flow of the markets right now? And we're seeing. I mentioned, I think, in talking in one of the shows the other day, I was talking about maybe dropping down to 250 on the Treasury, maybe as low as 240 might be a strong possibility during this segment, this sequence. And if that happens, it does not mean that the markets are going to be better. It's like the bonds are taken away. Some of the relationships of cash flow are coming back into play. The theme of the annual report was actually normalization of the markets, and even though we're seeing normalization could mean that in real world the rates should be a lot higher if they were normalized, but they're still being artificially manipulated both through the actions of the Fed. There's still QE going on, but more importantly, the posturing they're trying to give is giving market participants a little shift in sentiment, which will drive that market a lot more. The sentiment, to me, really has a lot to do with the emotions that are behind this market. So these are reasons why I talk about this black line that's on this page here. That is actually the S&P 500. So we overlaid that so you can see how the ebbs and flows of the database is happening. Very possible. Last time we got down to right at 43%. Let me just bring up the whiteboard and show you a couple things. I want to complete some thoughts here that I think are important. Is what we see this situation right over here. This was in 2012. Right here, this was the range we got down to was about 44%. Well, we're pushing back down to 47. We're pretty close to that point. It held last time right at the point where it needed to hold to keep a general uptrend going. So that's the key line I'm watching right now to see what happens if it turns like this week. If we turn south, we have a shortened week this week, and if we turn south and there's some further lower numbers and more breakdowns of internal trends, we could see this break happen coming into next week. This could be very possible. And So this is a real key element from the standpoint of what's going on with the database. And like I said, we will do more now that we kind of teased you a little bit with this new transparency that we put in on VPM Connect. We'll do some meetings that will specifically talk about those things that we're seeing there. I want to go into a portfolio here real quick, and so I want to look at the Global Equity 4, which has 2 cells. So you can see we're moving about 50% cash here, and we were 94% invested last week. We're now moving to 50.55. Because of the nature of this particular portfolio, you're really going to get those type of movements. And so this is, I think, probably the most important thing I'm going to say today from the standpoint of utilizing VPM and understanding what it's doing is really important here. And VPM, if you look back, this goes back to 03, you get advancing segments. So you participate, you get a flat segment, and this is the way that this software should work. So each time people were, I guess we had advisors that were upset that the VPM, this global equity strategy, didn't keep up with the S&P. Well, it's not an S&P strategy, number one. It's a global equity strategy, so there's other elements. This volatility did exactly, I was arguing with a lot of folks that this is exactly what should have been happening during this period of time. If you notice, we go flat, and that was from 2011 to 13, and when the market trended again, we participated. And what's happened over time, this, if you did every trade as they were designed, whipsaw, whatever you want to call it, you ended up doing really well. You ended up, with this equity advancing substantially. And that's all we're trying to do, is to stair step the equity higher over time. So it's not about winning and beating the index every time. It's about understanding the compounded rate of returns, understanding that if you can generate a 7 to 9% compounded rate of return regardless of the market over time, over 3 and 5 and 10-year windows, you are absolutely going to be one of the best advisors on the street. And that means when the market's, just like when the market was down 44% in 08, you wouldn't be down 44. So the next year, it's the compounding rate of return over time that really is going to make this thing happen. And you can see we went from 100,000 to, I don't have the, 311,000 from 2003 till now. That's called tripling your money. And it had to do with everything that was done, every trade, every whipsaw, everything, just doing it as the software puts out there. And it's very difficult. And then one of the things we're going to have a segment talking about when you're authenticating and bringing this stuff in your practice into your customers, how that's going to work out as far as as far as letting them understand that this is really what this software is doing. And this is what I designed it to do. It's a risk-adjusted rate of return. And there's going to be, I think in the 2010 or 2011 national conference, I did a presentation talking about leading and lagging performance windows. And that happens. That's why if you go to Morningstar and you look at mutual funds, they have, they'll have leading and there'll be a 3-star this year, a 5 next year, and a 2-star. And it has to do with style boxes. It has to do with a lot of elements that you're bringing into these strategies. But what we're doing right now, potentially, is setting up a flat zone. And so the point of VPM is to be able to flatten out this general activity. So if we're looking at the stock market, it might decline sharply. What we want to do is generate some kind of range where these two arrows going horizontal are, We want to set up a range so the next thing we can do is start to push this market higher again, and so that in the next window where the market is going up, we're participating. When it's going down, we're not participating, we're protecting. So that's the PPG, participate, protect, and grow. If you participate when there's trends, you protect when the trends are somewhat I guess erratic, which would be a good example of 2011 through 13. You can say once 2013 happened, we had a big trend, we participated in it, and we moved the equity. So by just doing this simple strategy, it was able to triple the money from 2003. So roughly that's 12 years, but even if you look at you more than doubled your money. So if you start to look at the compounded rate of returns here, it's substantial. So trying to bring in some perspective and from my viewpoint, what I want this software to do. Now, equity strategies, you can get a lot more bang out of your buck because you can buy the Netflix and the J&Js and stocks that will go up 40, 50, 100, multiple, maybe 300%, and those will add a lot of value. One of the things we'll bring in on the sessions when we start to get into VPM is really bringing in some of the more technical aspects in the rotation, showing some what we call participation charts to show exactly each trade, what the trade impact is on the portfolio. That's really important to understand. So in the case of this global equity strategy, we have 30% tranches that come in when the market comes in. So we sold 2 today and we're 50-50. The market can consolidate for maybe throughout the summer, maybe stay in a range, and maybe we'll hold what we have, maybe downsize and go to a little more cash just as the risk would increase if the momentum flattened out, but being ready to buy back in to participate on that next rally. And that's what we're seeing in the database today. Let's go back just to finalize to say today's session. I'm going to go back to the actual market and summarize there as we're coming into the final 10 minutes of we're trying to keep these to exactly an hour. We know you guys have lots to do. Nice thing is within 5 minutes of this we finish this session, you're going to be able to watch this. We'll make these videos public on the Ustream channel, and then over the next hour or two, we will actually have them up on our YouTube stream is the Market Thunder YouTube channel that we have, so you can do that. The markets are continue to stabilize, like I talked about earlier. They tried another run. They're probably not going to make any new highs for a while. Now we're still within a couple points. It looks like we actually did print a new high. I thought by a tick here, and now it's pulled back again. So there's not a lot going on. As we look through some of the other charts, we're going to see a more significant breakdown of these patterns. And I plan on, just to mention, I plan on going through these charts here. You see there's a lot of lines on here. This is what I call the VPM webs, and I'll do a session and talk about these webs, and they're really about pattern recognition and understanding different types of turning points in the marketplace. And I developed these way back in, I think it was 1999 or 90. Yeah, it was actually 1996 when I did these. These have been a part of my staple for a long time from an analysis standpoint, and not necessarily a trading, but understanding market movements and switches and what's going on. We can utilize these all the way through the spectrum. Of course, we can go here and look at a shorter term 60-minute chart, so you can see how there was a downtrend here, and now we're seeing a little bit of a trend. And it's really interesting from the standpoint of what my work has been for the better part of probably 27 years now. I've been doing this for about 35, and maybe it's closer to 30 years. But what I look for is the way moving averages. These are the 1021 period moving averages. It's an hourly graph, but they happen on any chart I'm looking at, and understanding how the market moves around that. If you notice, this green line up here is let me get the whiteboard out, and I'll do a quick little review of this. But the green line is actually that's flowing right here. You see the market just topped out right along that line. We don't have the PPMs for that on this particular screen, but this trend, there's enough downward pressure here to set the tone for a point for the market to make a turning point. So we went down, and this is short term, but it's the same analysis no matter what. Now we see this is this middle line right here, this indicator here. Yeah, you know what? I am wrong. Let me take that off. This indicator here is actually tracking the 10-day or 10-hour moving average. So I lost my whiteboard. It's like, so this is tracking this average here, and it's showing that it is up very slightly, and it's accelerated. So what that means is we're going to get more of the moving average starting to turn up like this, and what will happen is these other averages will meet, and if it crosses all the way through, then this will be setting up some sort of move like this as a pattern. The market should stall around these numbers, and then once it starts to go up, then we'll see the market start to move above these averages, and then start a move up. And this is going to be typical technical resistance line up at this level. So this is, once again, just an hourly graph. The patterns are patterns. If you took the name off of this chart, you took the time off the chart, it wouldn't matter. The type of analysis would be the same, and that's the point of having a good solid technical viewpoint of what's going on with this. So we'll go ahead and take that off. We've got about 5 minutes to go. I want to take one real quick look at something that I think we haven't talked about. I'm going to find the right chart here. We want to take a look and just look at interest rates very quickly here. And we grab the 10-year. I'll make this a bit bigger so you can see it. And we're continuing. This is the daily. I'm going to go to the weekly graph here. This chart, it's kind of hard. There's too many indicators. I need to clean this up so you can see it. But basically, we're pretty flat across the board. The 21-week moving average is down on this right now. We're looking at 264 on yields. And like I said, we could move down into this 250, 240 range over the next several weeks. We're starting to see some of these indicators down below starting to turn and lose their downward momentum. So I don't think there's a lot of downside in yields. I think it'll stall probably no more than around maybe the 235 area would be an extreme. I think more likely it's going to end up around 250, and this is going to end up being a pretty good point for the markets to start to make some shifts from the stock market viewpoint. And what we're seeing is a classic flight to quality. So that's why we've got a decent bid in the bonds right now. There seems to be cash flow going back into bonds. See real quick here, I've got 4 minutes. See if we can bring up some gold here. Just take a look. Let me get off of this into, okay, we're on a weekly. I'm gonna take a couple things off here real quick because it's just getting too hard to see the chart. So this will give us a little better view, and I'll get the whiteboard out and just go through what's going on with gold. I know a lot of folks have gold in your strategies, and once again referencing the annual report that we did, the outlook that I did. You're looking at, I'm still expecting this market to move up toward the mid, let's say 1460s, 1480s. This appears to me to be a classic pattern. You've got the consolidation, you've got the moving averages all starting to form a base right here. And the next event, you can see right now, some of these numbers might be a little small, but I put an arrow over here on the left side with 0.60. That's a very strong trend. That's the 10-week moving average. The 21-week is fairly flat, and we get a 0.20 on the 40. But all three averages have actually turned up, which tells me there's a bias to the upside in this market. We went right down to the bottom average, and we're starting to get back above those zones. So once we can see this market move higher through here, we should see it move up to the 1400s. This is the futures contract, not the cash. I guess what I could do here, let me get off my whiteboard really quickly. What time we got left? We got 2 minutes to go. Just to keep everything on line here, I just know that this is still, if you look at our outlook, the numbers I have out there are still valid. Nothing's invalidated. We've had a nice move into some of the resistance and around the mid 1300s, and I believe this will, once we get above this last high that we had just several weeks ago, then this market should continue to go up. So we'll come back live to you. In closing, I really want to thank you again for spending the time. We're trying to cover as much information as we can just to keep you involved with the process, understanding what we're doing from a technical viewpoint, having good dialogue. Excuse me 1 second. I bought this book, You May Be Flash Boys, and I've been reading it, and this is the biggest piece of garbage ever written on the planet, and it's gotten a lot of tractions, and I'm going to, at some stage here in the short, as soon as I get a few more things read and understand what's going on, I want to have a dialogue with that, because I believe it's important. This book has gotten enough traction that clients might ask you about the markets being rigged and all this stuff. I can't figure out. Michael Lewis has some sort of an agenda. I don't know what it is. I'm trying to figure that out on some of his writings. In fact, he's done a great job. He even got me to buy the book, and But I do want to understand that, because I think we need to have a dialogue for people understanding it. One of the other things that I want to do in a session, it'll probably be with the Michael Lewis session, is that what I want to do is talk about the book and some of the assumptions and things that he's making in there. I want to talk about price discovery. I spent many years on trading pits and understanding and watching market movement every day, and watching how I've seen the flash bids and the flash offers, and I know that the high frequency traders are out there and doing their thing. And I have stories going back into the 1990s when I was on the Pacific Options Exchange, talking about exactly what we saw, that stuff way back when. This is an old trick by big players. They've always done it. There's the transparency is minimal, always has been. The difference is we operate in nanoseconds now, and we used to operate in minutes. So anyway, I want to thank you all for coming again today. We really appreciate it. We're planning on, like I said, doing a number of segments and just having an ongoing dialogue. And if you can't make it to the meetings, you can certainly watch the videos, and we're just going to continue this on. So once again, we want to thank you for showing up, and we will be talking to you soon.